You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Bullard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. So getting funds is often the toughest part of any project. When it comes to hard money loans, I think a lot of investors are scared to begin, don't know where to start, very concerned about that. Today we're going to demystify all of that with Michael Bourque, who's the CEO of LendingHome, one of the country's biggest lenders to real estate investors. And he became the CEO of LendingHome at the end of 2020. He's got decades of experience, and LendingHome was established in 2013, and it's originated over $7 billion in loans so far. So welcome, Michael.
Thank you. Thrilled to be here.
Well, let's talk about the current market, because I feel like it's a little bit challenging for anyone who wants to be in the flipping business. Return on investment, awesome. Prices have never been higher. Finding a deal and finding financing, that seems a little bit more challenging. So what are you seeing?
Yeah, I mean, for sure, it's been an interesting 18 months in real estate. We're actually still seeing just tremendous activity, both across our fix and flip product, as well as our single family rental product. It seems like each month this year, we're setting new company records, everything from loan submits to funded volumes. And it's really incredible to see. I think from a customer perspective, obviously housing inventory has been incredibly tight, but our customers are incredibly motivated, inventful, scrappy, and very good at finding opportunities both on and off market. And that's really what they're doing. I think the thing I'd say, though, is now more than ever, you really need to be prepared and know exactly what kind of project you want from a price, location, size, rehab perspective. So when something comes up that hits those marks, you're ready to move quickly, and that's what we're seeing.
That makes a lot of sense. Let's start with the basics. What is your flipping product, and what is the definition of a hard money loan?
Sure. So I don't really like that hard money term. I think it kind of harkens back to a day when real estate investors really struggled to find kind of contemporary tech-forward lending partners at reasonable rates and terms. The way we talk about it is just, we call them bridge loans. And really bridge loans are just short-term loans secured by real estate. And they're typically done for a property in transition. And so all of our lending is business purpose in nature. So we don't do anything that's owner occupied or consumer. And that's really how we define the product.
Interesting. So you couldn't use it for something like a house hack?
Not if you're living in the property.
And so these loans, they are generally at a higher interest rate, right, than like traditional loans. So are the prevailing interest rates that we're seeing, which have been obviously very, very low, do they impact the interest rates?
They do a bit. I think if you go back in time, historically, this space was funded by private lenders. Typically, they raised capital from high net worth individuals, didn't usually apply leverage. And so that high interest rate on the loan itself was usually enough to kind of shield investors from, interest rate fluctuations that might move around. As the space has become more institutionalized, as you've seen a lot more Wall Street capital come in, and through the efforts of companies like LendingHome, we've been able to reduce our cost of capital, and so in turn pass savings to customers. With that, though, kind of the exposure to interest rates has increased a bit. Just given how much of volumes are being financed by more traditional capital markets areas, but still a bit disconnected, less connected than the consumer mortgage space.
That makes sense. So the process itself, compared to the consumer mortgage space, generally a lot faster, right? What sort of qualifications are you looking for?
Yeah, so we really look at both the kind of the individual through the entity that they're typically borrowing in. Over 95% of our transactions are with entities, not individuals, but we do look through who some of the principals are. And then we look at the property characteristics, not just what it looks like today, but the scope of the renovations that the customer might be interested in. We run all sorts of analytics to basically predict what we think that property is going to be worth after the repair in say 6 to 7 months when that property could come back to market. But because it's business purpose in nature, it's a lot less. There's a lot less kind of there's no overlay of, let's say, the consumer kind of federal mortgage rules and requirements. And so in that sense, you're allowed to do things a bit more quickly. And there's less of that built in. Interesting.
So you said analytics. Are you using any kind of machine learning? Is this mostly done by people? What's that process look like right now?
Yeah, no, it's really a combination. So at LendingHome, we have a kind of a home built platform, invested between $90 and $100 million over the last 7 years building that out. It allows our customers to have kind of a seamless online experience. A lot of what we do is kind of standardized around that data, both ingesting information that's widely available and also kind of creating our own analytics. So we have, I think, 6 or 7 kind of AI machine learning models running today, typically looking at, what do we believe the after repair value is going to be of that home, and kind of crunching all of the different inputs to predict the value of that property. We still have, awesome, incredible people that help, shepherd loans through the process and perform kind of critical steps of the process. But more and more, we're seeing automation come in, remove more of the, let's say, less value add type activities, and allow our people to focus on the things that really matter, and make a difference both for us and for our customers.
Yeah, that makes sense, because that's a lot of what I'm hearing from other technology companies involved in real estate, is that really the machine learning and the AI just takes care of all of the things that are, sort of standard, and then flags the things that really need someone with expertise to take a look at.
Yep. Yeah, and it really gives great leverage too. It makes I think it makes our operation teams, it makes their jobs better. Removing some of the more routine, mundane type activities, if that can be done by the system, that's terrific. And also gives you great leverage. So as you grow, you're not, you kind of get some leverage on the technology, and you get benefit that way.
That makes sense. So let's talk a little bit about the rules for bridge loans. It seems like they vary a lot by state. Why is that, and do you think that that's going to change at any point?
Yeah, so it is different. I think it's similar in some ways to consumer mortgage, where each of the state regulatory bodies has their own requirements around consumer mortgage lending. I think on the business purpose side, it's far less than what you see on the consumer side, but you still have some differences state to state. I think the most common place you see engagement is really around kind of the cost to customers, whether it's in rates and points, to make sure that lenders aren't looking at usury like tactics and things like that. Some states have more involved licensing requirements than others. And different rules come into it. But what's interesting is that the bridge lending space is heavily fragmented, and it's existed this way for decades. Our analysis says there's over 22,000 lenders that are active in the space today. What's interesting is that it really had been a local game. And so, local lenders operated in their own, geographies and territories, and, introduced and evolved practices in those areas over time. And so you ended up with these almost like mini ecosystems of lending behaviors and norms that varied across different parts of the country. One of the things that we are really excited to do at LendingHome is bring, kind of a national view, or at least a more national view. We're in 28 states today, again, leveraging kind of the technology and the data analysis that we have to put together a very competitive loan package for customers and give them a great experience, to almost systematize the rules, around this type of lending activity, to fit any state. And so we're excited with the progress we've been able to make so far, and interested to continue to grow.
22,000 lenders, that's a lot. So do you think there's going to be some consolidation in that space? Is that what you're seeing right now?
Yeah, I think you've seen a handful of companies, 5, 6, 7 maybe, begin to kind of flex their muscles and grow more, and try to play beyond maybe a city or a state geography. There's been different regional lenders that have popped up in the Southeast or in California, or New England. And, as they've grown and found success, they continue to try to expand. And so I think that's just natural. We haven't seen yet a ton of, companies, buying up, top 10 like competitors. what we have seen is more and more of kind of the capital investments coming in to the space where, more traditional financial institutions are investing in these originators to get access to the high yielding loans, which is, provides those companies growth or capital to help grow their businesses. And in turn, the Wall Street institutions love the yield and the interest rates and the performance, especially most recently, from these types of loans. And so that's been an interesting dynamic that we've seen.
That makes sense. So I know that in the past, it seemed like people who are having businesses, they go to the same lender over and over. There wasn't really a lot of competition, partly because there were all of those smaller lenders. You just go to the guy that you always go to. Seems like that's starting to change a little bit. Maybe there's a little more competition. Is that also something you're taking a look at?
Yeah, I think a big part of it too is just transparency and the flow of information. So, if somebody can come to our site and, within, 5 or 10 minutes, input some information and understand what their lending terms might be, that's radically different from, where things were even 5 years ago. And so it allows, somebody to make sure that they're getting the best deal for them, whether that's in rated terms, and so we've seen, especially among more of the professional real estate investors and those who do a lot of projects and are very active, they're very sophisticated, and so they understand who's out there and the strengths of the relative companies, and really have almost set up their operations around their partner of choice to really make sure there's good integration. So this ends up being a seamless part of their operations.
Interesting. So is something like the CFPB involved in lending for these types of loans?
Again, because these are business purpose loans, I guess CFPB, the first letter is consumer. They're really not focused on a consumer product. That said, we're very mindful of all of the regulations that have grown up and evolved in the consumer mortgage space. I have a background in consumer mortgage servicing and certainly understand the requirements there, and are very mindful of fair lending practices and things like that. That we make sure we abide by. But it's not, I guess, in their mandate today, but nonetheless, a lot of the principles that they've evolved in that space, we and many of our competitors apply anyway.
That makes sense. So if you're a flipper planning your first project, you mentioned that you're working with entities, not individuals. So if you're a flipper, you're planning your first project, do you kind of need to set up an LLC first, or what do you need to do to start thinking about getting this type of loan?
Yeah, so in some states you have to be an entity, and others you don't. So it really just varies. You can do it online. It's a relatively quick process. Actually, to thinking about this question, I reached out to one of our sales leaders, Charles Goodwin, who's been with LendingHome for a long time, but is also a real estate investor and flipper himself. And what's interesting is so many real estate investors talk to each other and are willing to share their information. And so I asked him what he would share with people starting out. And, he had 4 or 5 things that I think are relevant. I think the first, make sure you research your local market. You really understand the area you're trying to dive into. Everything from, comps in the market today and where you think things are trending, but also understanding some of the details, like what features sell well in the area you're in. Oftentimes, you may have an expectation of a home you want to live in, but that may not fit in the neighborhood you're investing in, and you can kind of create an overinvestment situation that eats into your returns. And so really thinking about, the needs of the home, bedrooms, bathrooms, square footage, et cetera, and setting up a good view on the way in is important. Next is coming up with a budget and business plan, and really sticking to it. You need to build in flexibility because there will be things that come up that can jeopardize your returns. But planning ahead, creates wiggle room for you and an ability to weather some of those things that are certain to happen. Next is really developing strong relationships with your partners. Obviously I'll start with lenders, and having a lender you trust is critical to the success of a project, but equally important is making sure that you've got good, partners from whether it's real estate agents or stagers or contractors, attorneys, et cetera. Different investors will have different needs, but ultimately having a good team around you is really important. Next is setting up a really strict timeline with your contractors and only paying them incrementally as they complete work within the renovation. You don't want to advance too much cash. You don't want to take away an incentive for them to complete a project or a next step of a project on time. That's really helpful to keep things moving along. And then lastly, just make sure you stay educated. Things change constantly, especially today in this environment. Keep in the know, read, network, learn from others. Especially when you're starting out, everybody loves to share their horror stories and the things that, maybe burned them in the past. It's a great way to get started and benefit from lessons and tough times that others have been through, and really just ask questions. I think with that and with the right attitude and planning, it's something that I think anybody can do and get into and be successful, but you need to appreciate the responsibility you're taking on.
It's definitely risky, and I've heard some of those horror stories too. From the lender perspective, what happens when you've got a flipper who's sort of in trouble? Maybe there's that contractor delay that you were talking about or something like that. What happens when a loan starts going sideways?
Yeah, so one of the things that, another area or place we use data at LendingHome is kind of on the servicing side as well. And so what, a simple example would be, if we know, working backwards, if it's a 12-month loan, and let's say this was pre-pandemic in New Jersey, and the average days on market there could be 90 to 120 days, and you work backwards on their scope of work, and if, let's say, 2 months in, they haven't taken their first draw, which means, that they've spent money and they're starting to do the work. Given the scope of what they're trying to do, you can identify pretty easily that they might have some challenges around that timeline. And so one of the things we do is proactively identify, just based on the progress people are making through their loans, whether or not we think the timeline's at risk. We reach out to them, understand the situation. It could be delays in permitting. It could be issues with contractors, as you mentioned. But one of the things that we've been able to do proactively with many customers that have found themselves in different situations is actually identify maybe a partner for them, pair them up with another real estate investor in the area who might help them get that project to completion, buy them out of the property. And so really looking at different ways to help make sure that they can kind of get through it. As you get through the renovation, or you get later in the project and maybe the markets change, or there's a localized issue, or let's say COVID comes up and everybody's trying to figure out what that means. We really try to make sure we work with our customers to figure out, the best situation. Oftentimes it could be just extending the loan term 3 months. If the property's finished and it's just getting listed, we feel good about that. That's something that we do, I don't know, maybe 10% of the time. But really it's about working with customers, understanding their situation, and then looking at what the data tells us relative to, where we think the house is positioned, what the market's doing, and what's going to be the best outcome for our customer.
Well, you mentioned the pandemic a couple of times there. What was that like for LendingHome, and where are you at now?
Yeah, I think like everybody, the situation was a bit scary. One of the things, I guess, specifically related to LendingHome, we fund our business using revolving securitizations. And a way to think about that is, every 4 or 5 months, we issue another one. It gives us almost semi-permanent capital, and we have our maturities laddered out over multiple years. And so we had access to capital through day one of the pandemic, and when many of our competitors didn't. And so as things were evolving and you saw a lot of the, mortgage and commercial mortgage REITs trying to figure out their liquidity situation, they weren't in a position to buy loans from our competitors, and many of our competitors actually closed their doors. And there was a moment where it really hit home. Word got out that we were still open. We still had capital. We were funding loans, and I think between a Friday night and a Sunday morning, we saw 30 million of loan submits come in. And it was really startling because, we, like everybody else, didn't know what was going to happen. And so we made some adjustments to our terms. We lowered leverage. We increased prices and fees a little bit just to make sure that we were using our capital wisely and creating flexibility. But what's interesting is through that process, we were able to, stand by our best customers, or all of our customers, but also demonstrate to many of the best customers at our competitors that we were reliable. We were there. We were going to be able to support them through the process. Maybe the terms would be a little bit different, but we were there to help them. And so we actually won a significant number of great customers from some of our competitors, and really haven't looked back. I think with a little bit of a self-imposed pause in some of our growth right at the start of the pandemic, I think we might have bottomed out around 75 million of lending that month. We're up to almost 300 million a month now, and really are proud of how we've been able to support our real estate investor customers through this process.
That's fantastic. Let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's REAL.fool.com.
Great. Thank you so much, Matt.
I'm back with Michael Bourque of LendingHome, and we're talking about financing for real estate investing. So before the break, we talked a little bit about the pandemic. One of the things that I'm keeping an eye on right now is the massive scramble for single-family rental homes. We've got companies like Invitation Homes. We've got private, non-traded REITs putting billions of dollars towards this. We've got individual investors trying to find homes. What is that looking like from your perspective?
Yeah, it's been fascinating to see the institutional investor demand in the space. And what I think you realize is all these companies are looking at two or three big things driving their investment decisions. They want yield. They have money to put to work. Single family homes and single family rental homes in particular are generally a relatively safe asset class. And interestingly, it's also a great hedge against inflation, as both property values and rents should rise with inflation. And so today, with kind of the specter of inflation on the horizon, I think it's a place where a lot of folks are looking to put money to work. And so, we've seen the reports like everybody else of institutional investors competing with homeowners to purchase new homes, but systematically haven't really seen this become an issue yet for our customers. I think if you think about the nature of the types of homes our customers are targeting, typically aged homes in need of renovations. The institutional investors are really targeting something a bit different, more move-in ready homes or homes that maybe require less repair. And they're really focused on trying to buy homogeneous properties outside of kind of the suburban metro areas, Atlanta, Phoenix, et cetera, where things are pretty standard. That said, we've heard from some customers that institutional investors have actually started becoming the buyers of their homes, or we'll say the takeout on the property after they finish the renovation, because now those homes are move-in ready and become good additions to those SFR portfolios. But it's definitely an interesting trend and something that we're going to watch closely.
Well, I think the other thing that fascinates me about that trend too is the relationship between those institutional portfolios and the iBuyers. Redfin, Zillow, Opendoor. We're seeing a lot of iBuyers in certain markets that are then selling properties to those institutional portfolios. Does the rise of the iBuyer have any impact on your customers in terms of competition?
Yes and no. I think it if you take a step back, what our customers are doing and what the iBuyers are doing is basically taking an existing home, making some improvements to it, and then bringing it back to the market today. The difference being that the iBuyers really are focusing on cosmetic rehabs, maybe homes that require $5 or $10 grand worth of renovation versus something that might require 30 or 40. And they're really also only looking at homes built, let's say, from 1995 or 2000 to today. If you were to just plot the age of, or the birth year of each home that those companies have transacted, I think the average age is, it's like the year 1999 or 2000. If you compare that to all the transactions LendingHome has done in its history, that date is 1966. So in some ways, our customers are kind of doing the same thing. Some of the iBuyers are, but focused on a very different property, and that being kind of the aged home of America.
Interesting. That's one of the things that I'm thinking a lot about when it comes to the iBuyers, because they're just starting to get into those older, like Northeast markets where you've got more older homes, properties that are all a little bit, have their own quirks versus ones that are like all in a single development. You brought up loan size. What is the average loan size at LendingHome?
Yeah, today it's about 80,000. 280,000.
Excellent. So wanted to ask you about another product that you have, because you have this program for people who are building a rental property business, and I think that's really fascinating. How does that work?
Yeah. So the impetus for us launching this product really just came from our customers. Simply they wanted the ability to hold on to a renovated home and earn their return by cash flowing the property over time instead of having to sell it. So really deploying a buy, fix, rent strategy. And so we've seen cases where customers will start flipping homes with us, and then they'll say, I want to take one out of every third or fourth flip, and I want to keep it and become a landlord as a way for them to build up a passive income portfolio and really like a cash flowing annuity that can provide them income over time. And what people say is that, they love real estate investing. They love, the process of flipping homes, but it is operationally intensive. And so at some point they're going to want to stop. And so having a portfolio of rental homes that kind of can provide, a sustained cash flowing income is attractive to them. And so our rental product gives them an easy way to refinance refinance their bridge loan into a rental loan with the same great level of service and a competitive product. And so we're really excited to see the adoption of the product so far. It's still relatively small compared to our bridge business, but we're really excited about the future of the product.
It makes sense because I know so many investors are interested in the BRRRR method, and that's something we've talked a lot about on the podcast. On these mortgages, it looks like you're offering adjustable rates, shorter terms, 5 and 7 year. Why is that?
Yeah, so we have a range of offerings, everything from a 30-year fixed to the ARMs that you mentioned. Really, it's just about giving customers the flexibility to find the product that works for them. Oftentimes we have customers who want to lock in a 30-year fixed mortgage as they see their ownership horizon as indefinite and maybe even something they want to pass on to their kids someday. But other times they might be operating with a shorter time horizon, and a 5 to 7 year product might work for them. The other thing is that sometimes drives the interest in this product is just the relative cash flow implications on a property, as obviously the mortgage payments on a 5 to 7 year ARM are typically lower than a fixed rate mortgage, and that's something that sometimes people opt for as well.
Excellent. So I noticed that you've refinanced a few larger projects. There was a rental home community in Florida. Are you thinking about getting more into that business? It sounds like that's maybe a small portion of LendingHome's portfolio right now, but is it something you're planning to expand?
We are. In the situation you referenced, we were actually the bridge lender on, I think it was something like 50 homes in that community. And we're excited to refinance them into a portfolio rental loan and actually satisfy the needs of what the customer wanted. It was a great relationship for us, and we were excited to do that. And that's really how we're thinking about product expansion, both for lending products and non-lending products, is trying to answer the question, what do our customers need next to be successful? Or said another way, like how can we help our customers grow their business? And so we've had the privilege to work with some customers that have done hundreds of flips with us and then begin taking rental loans with us. And as they continue to build that inventory of rental homes, we want to be able to be there to offer them a portfolio rental loan when it makes sense for them to do that and keep that relationship. And so really, as we see it as our customers build and grow their business and find success, we want to be able to build and grow with them. And that's what's driving the expansion.
Interesting. So you said you've got customers that have hundreds of flips. What's the average? Is the average someone who's done a few flips or someone who's done a lot of flips? Who's your target average customer?
Yeah, I mean, we serve every type of customer well, but we serve them differently. In any given month, about 80% of our loans are done with more of like professional type real estate investors, people who might do 5 or more transactions in a given year. And given that experience and that track record, they end up with a kind of a different customer experience than somebody who maybe is just starting out. But we serve those customers equally well. And so it's really exciting to see. We've had many customers who come in, have learned the business and have grown up, kind of from first timers into professionals and really have, generated meaningful wealth, impacted their communities in a great way. And so it's exciting to see. But, the majority of our transactions today are with professional real estate investors, but we're very much invested in helping build and grow the next generation of professionals at the same time.
I love that. You have a product for passive income for accredited investors. That's fascinating to me. What is that and how does it work?
Over the years, we've had different strategies to fund the business. Everything from a peer-to-peer marketplace at the beginning of the company's life, where accredited retail investors could buy fractional shares in loans, to a managed fund, to the securitizations that we're running now. Each kind of step in this journey brought with it a much more competitive cost of capital, which we've used to help grow the business, also lower our costs for our customers. And so in the case you mentioned, we were at a point where the peer-to-peer marketplace just wasn't competitive enough relative to what institutional investors would want to pay for those loans through our securitizations. So a retail investor might want a 7 or 8% interest rate on a loan, and we were selling loans into our securitizations, let's say at 4%. It's just a very big difference from a cost of capital perspective. And so as we thought about the evolution of the marketplace, we still had tens of millions of dollars on the platform invested in loans that were in various stages of paying off. And Arvind Mohan, our CEO at the time, or COO today and leader of our capital markets at the time, had the idea to see if investors would actually want to just keep their money with LendingHome, but this time in the form of some unsecured notes. And what we found was enough of them did. And so we have now a population of accredited retail investors earning about a 6% annual return on what turns out to be 90-day notes. And so it's not something we've marketed broadly, and but it has been a nice solution for these investors who wanted a place they were comfortable parking this capital, and it's also helped us just from an ongoing working capital perspective to have that available.
Interesting. So you became CEO right around the time that LendingHome raised its Series E funding round. What is next for LendingHome in terms of, is it going to be actively raising another round? Is there any chance you're thinking about early stages of going public? Have you had any offers from SPACs? What's that sort of climate like for you?
Yeah, it's been a really interesting journey since taking over in December. We, like everybody in kind of in the fast-growing fintech space, observed and had some conversations around, what was taking place in the SPAC market. I think for us, we're really focused on just continuing to try to build and grow what we believe is a really special company. We mentioned kind of the recovery and the growth we've seen, since the pandemic. We're really proud of how we've been able to continue to win and support customers in this environment. We're continuing to invest in our machine learning and automation technologies to help our customers make good decisions, and continue to find ways to help them be successful. And so, look, at some point, will we, be a public company? I would imagine that. But, we're still very focused on building and growing, the company and supporting customers, every day.
Are there other products that you're thinking about rolling out?
Yeah. So we mentioned the addition, kind of the additions into portfolio rental. There's also, probably some changes coming around our ability to do multifamily properties as well as new construction. A lot of our customers, evolve into those places. And as I said before, we want to be able to support them as they build and grow their business. And that's a likely extension of that. I think the other thing that we're really focused on is, and really identified, what's made us successful is kind of the integration of this seamless platform with, kind of the data now that we've accumulated over 35,000 transactions, over 900 million data points, that we have turned our kind of machine learning tools towards to identify the real drivers of success. And so as we sit here today, what we're really thinking through is, how do we help use that information we have to help make our customers be more successful, whether it's at the start of their journey with a property, understanding, what could that investment turn into? How might they think about a renovation, scope of work, a timeline, risk, returns, et cetera, all the way through, what they might do to renovate that home, who they might work with, and then ultimately, there's been so much change in the real estate space, but at the back end, when the project is done, what might an exit look like for them, and are there things that we can help them with in that journey? And so, we're really thinking kind of wing to wing about how do we help continue to make our customers successful, from this first step on a project all the way through to the end. And again, leveraging the strengths that we've built up over, our 7 years now and all these transactions, to help set our customers up for success. So more to come. We're not going to kind of give away the secrets here, but, we're really excited about what's in front of the company.
That's fantastic. You mentioned new construction. That makes me think a lot about build to rent for single family, which I've been following. We just keep seeing more and more news on that. Is that something that you're also paying attention to?
Absolutely. I think, I was looking at something this morning. I think there's, over 500 build for rent projects ongoing right now in different parts of the country. And it's certainly a strategy. So we've seen it at kind of a micro level with one individual borrower, buying a home, renovating, turning it into a rental. Now actually like special purpose building for rental is becoming more and more common. And so that's something that we're looking at. And again, as we, continue to evolve, I'm sure that's something that, we'll take a really hard look at, again, and trying to continue to serve these customers who are incredibly innovative, finding ways to build and grow their businesses and serve the communities they're in.
Fantastic. Well, I think you touched on this a little bit, but last question for you. Where do you hope LendingHome will be in 5 years?
We're so excited about the future of LendingHome. I mean, it's maybe a little hokey, but simply, we want to be the first company people think about when contemplating or financing a real estate investment. We've talked about the expansion in our traditional lending products. There's a tremendous amount of runway there to continue to grow, just by supporting our customers' ambitions across fix and flip and rental. But all these new product extensions are also, really exciting opportunities for us. I think, I hit on some of the opportunities around new products and new technology that we're working on. I'm trying to help drive success at every step of the real estate process. One example is the property marketplace that we launched, I think at the end of 2019. It's now live on our site. It's a way for customers to come and get access to curated, often exclusive listings that they might not otherwise have seen or have had access to. And the idea being, everything out there, we believe is attractive returns for a real estate investor, but also building other solutions to help make their efforts to find and evaluate properties simpler, easier, and really to put the power of our unique data in their hands early in the process to help set them up for success. So it's a lot. It's a big ambition, but I think we've got an awesome team. We've got great customers that we're honored to work with every day, and really excited about the company we're building.
Fantastic. Well, thank you so much for your time today. Reminder to listeners, you can find out more at LendingHome.com, learn about the products they offer. You can always email us at media@millionacres.com to share your thoughts. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Million Acres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.